Let's bring in our next expert guest. It is Etienne Bordeleau Labrecque. He is Vice President and Portfolio Manager at Ninepoint Partners. Etienne, thank you a lot for coming in. What's your overall take on what you've heard? You've heard a lot today, the announcement, the press conference, the statement. What are your thoughts?
Yeah, so I think that was as expected. The bank has been pretty clear in its last few meetings that they're focused on inflation. Despite the weakening economy, there's a lot of moving parts, a lot of distortions in Canadian data this year. Between the HST, GST rebate we had in December and January, February, that distorted inflation. We had the trade war, the front-loading of exports, a lot of front-loading of purchases too, people fearing that price of goods might go up. So there's a lot of distortions. The first half of the year is essentially distorted. So it takes a while for the data to speak really to what's going on in the economy. That's why I think, to one of your last points, that they're trying more outreach directly to households, to businesses, to try to get a better sense of what's going on the ground, because the data is so heavily distorted. So focus on inflation, very distorted data so far this year, and I think that the bank will drag its feet for further rate cuts. So that's why, unless we see a real improvement in inflation, if we can tell by the time of the July meeting that the increase we saw this past month was truly a blip in core, I think it's unlikely the cut.
Yeah, this question of what turns up in the May and June inflation reports is becoming a very interesting question, isn't it? For reasons that I tried to explain. When those reports are released, Etienne, what will you be looking at in particular? Well,
Governor Macklem said we are not yet seeing the impact of retaliatory tariffs, so that will be something we'll be looking for. Obviously, we get a lot of help from the carbon tax removal, consumer carbon tax. But looking through that, are these other categories moving up as well? Food has been moving higher, goods as well. And then our services, as the economy is slowing down, as the unemployment rate moving higher, our services inflation declining. This is the push and pull that the bank has been talking about. And we clearly see, the domestic economy, final demand for Q1 was negative, unemployment rates going higher, home sales in the two largest markets in the country are down double digits year on year. So you're seeing these signs of weakness in the services economy, in the domestic economy, and that's being counterbalanced by higher inflation from what we import from abroad, a lot of goods.
So that's your view on the inflation side of the equation. What about the growth side of the equation? One of the quotes from the statement from the bank today, the economy is soft but not sharply weaker. Now, how should we interpret that?
Well, as it sounds, as I said, Q1 was heavily distorted. Final domestic demand was negative. Consumer spending was still positive, but consumer spending never goes negative. Even during the GFC, I think it was flat for a few quarters. So don't expect consumer spending to decline. Business investment was surprisingly strong. So keep an eye on that, because that's what's really should be affected the most by uncertainty because of the trade war. So if that drops in Q2, if consumer spending remains at these low levels or keeps declining a little bit, housing investment doesn't look like it's going to accelerate. And then that leaves us with net exports, which were a big help in Q1. So that's why everybody's expecting a very weak Q2. I think, will that be the trough and then we come back from that? Do we get some resolution in front from this trade war? And can we see this Q2 weakness as the bottom, or does that weakness continue? I think that's going to be the big question this summer. That's why I think we won't know until late summer, early fall, whether or not we get another round of rate cuts towards a more stimulative stance, or do we stay on hold for the foreseeable future? So
the fixed income market right at this moment is calling July 30th a coin flip, basically a 50% chance of a rate cut, and by extension, of course, a 50% chance of no rate cut. You clearly think we don't know enough today to make an educated forecast as to what the bank will do on that day, correct?
I agree, and I think that's what the market's telling you. A coin flip is essentially, we need to see more data before we know. If inflation comes in better than expected, and if economic data continues to surprise to the downside, and we're going to get the payroll report on Friday. Unemployment rate's already at 6.9%. We've had job losses in several consecutive months, particularly if you exclude the election in the last month. So the labor market's clearly weakening, and so we need to, if we see more economic data weakening and inflation is okay, then I think they get a pass for a cut in July.
The bank deflected a question about the rally in the Canadian dollar. The bank always deflects those type of questions. The bank's official position is we don't adjust interest rates for the benefit or to affect the Canadian dollar. However, the question was an interesting one. Would the bank view a stronger Canadian dollar as disinflationary, because all those products that we buy from the United States or from other countries become a little less expensive when the Canadian dollar is stronger? What are your thoughts?
Well, I think it will help the margin. We need to look at inflation is a year-on-year measure for the most part, so we need to look at year-on-year. So we had a very weak Canadian dollar in the first quarter and then late last year. So I would need to look at what it was in Q2 of last year to give you a proper answer. But certainly the strength in the dollar is probably a relief. Further weakness in the Canadian dollar would have been an issue for the bank if we had kept going the way we were going.
Do you have a forecast on the Canadian dollar?
I do not. What I can tell you is that I see the recent strength in the Canadian dollar more as a reflection of what's going on with the U.S. economy as opposed to a sign of an endorsement of the strength of the Canadian economy. I think it's more of a reflection, and you see that through multiple currency pairs. I mean, the Canadian dollar is one of many major currencies that have appreciated against the dollar. Right.
So you told us earlier you think the Bank of Canada, in your words, will drag its feet before cutting rates again. Is it possible, Etienne, that the Bank of Canada is finished for 2025 in cutting rates?
If the economy recovers post Q2, everybody assumes a bad Q2, so they will look through that. If the economy recovers, and inflation remains stubbornly high, I think it's highly probable that they won't cut interest rates any further. Just like the Fed, if the economy remains strong enough, the labor market doesn't deteriorate, I think that it's highly likely they drag their feet until the fall and maybe don't cut at all.
Tiff Macklem strongly endorsed the idea of diversifying trade away from the United States and strongly endorsed the idea of reduced trade barriers here in Canada to develop our own internal market. Is it and both of those are stated priorities of Mark Carney and the new Liberal government as well. Is it unusual at all to hear a Bank of Canada governor explicitly endorse what our government policies are? Are these issues so big and make so much evident sense that that's not so much of a surprise?
Yeah, I think that's kind of it's an evidence. It's pretty much a no-brainer that we're heavily reliant on the U.S. because of what he just said, we're proximity. It's easy to drive these trucks across the border. It's a lot harder to ship goods across the Atlantic, the Pacific. So it makes sense. I think it's a no-brainer. Everybody agrees on that. Whether it's central bankers, premiers, and the Prime Minister.
Etienne, thank you so much.
My pleasure.
Etienne Bordeleau Labrecque is Vice President and Portfolio Manager at Ninepoint Partners.